Good morning, ladies and gentlemen. Welcome to the mid-year update of our UOB Global Research and Market Strategy team. This webinar is organized by the Global Markets team. And just a few quick admin matters before we head into the webinar proper. First, you will see a little box at the bottom with the question mark. So if you do have any burning questions for our panelists, do put them in, and we'll try to answer your questions at the Q&A later. For today, we have a very packed schedule of quite a few of our research team members updating on the landscape of macro and markets for the second half of the year. We'll start off with Tekin, our head of research, who will give us a quick update on the key concerns for the second half of the year, namely tariff, growth, and Fed outlook. Then we'll head into Enrico, who will give us a run-through of the views and expectations of ASEAN economies, specifically how various ASEAN economies are affected by the trade tariffs. And then Julia will come on. Some of you will be familiar with Julia. Julia's our senior economist from KL. She'll give a quick update on Malaysia and what to expect from Bank Negara as well. And finally, we have our Peter Chia, who will give a quick rundown of basically FX commodities outlook and whether the US dollar will get even more weaker from here on. And finally, we'll do a quick Q&A. So gentle reminder to all our presenters, as this is a very tight schedule, do stick to your 15-minute slot. And for our viewers out there, if you have not received the latest FX and rates monthly report that was just published 2 days ago, do reach out to your relationship manager and global markets salesperson. They can update you of our latest views and forecast for currencies and rates. So without further ado, Tekin, please take it away. Thank you.
Thank you, Khun Hao. Good morning, everyone. And it's a good Friday morning, everyone. And thank you for spending time with us. Like Khun Hao said, we have quite a tight schedule. So today I will cover this segment on what's the tariff outlook, and also Fed, as well as the dollar situation, which I think this Peter will walk through with you even more later. All right, so we have this tariff situation right now is still developing, and that creates quite a bit of volatility for many of us, and also for the market participants. And this market volatility could resurface later, although there are some signs that things are calming down. And what we should expecting will be some kind of deals going through. Yesterday, we heard about Vietnam, right, having a deal with the US, 20%, and that kind of deal could be a template, may or may not, because it might be some country-specific deals as well. So we do have to keep an eye on the kind of potential impact on this on the financial market, right? And the second thing is that for the Fed itself, we're still looking at the easing to take place, right? Later we'll walk through with you some of the reasons why we are doing that, why we are calling for 3 interest rate cuts for this year. And then finally, of course, you have these geopolitical development changes. Iran and the US, and also US and China, and all those things that are still evolving. And of course, one of the focus areas is the role of the dollar, and the dollar weakness that we have seen recently for the past 6 months or so. What does that mean to us? Is that going to weaken further, or is it a sign of de-dollarization? I will address the de-dollarization part here, and Peter, in the final segment, will tell you more about where a dollar is headed and what you should be doing in your with your dollar position. All right, in terms of tariff policy, as we can see, there's very limited visibility right now, except those that have been announced. Even yesterday, the US deal, so to speak, with Vietnam, there's not so much official statement coming out from both countries, right? Only the U.S. President Trump um, giving the statement through his social media, right? There's not so much. So that underlines how volatile the situation is, right? Because I think behind the scene, officials are making probably hammering out the details, what would be involved in those the 10%, 20% for Vietnam, between Vietnam and US, and also the 40% for transshipment, right? More details to be forthcoming. But what I would like to do here is bring you back to 2nd of April, right? 2nd of April, where the US President Trump announced these reciprocal tariff. If you look at the rates, just a reminder, the rates that have been applied to many countries, they are all above, all way well above 20%, particularly some of these countries in Southeast Asia. For instance, Vietnam, we have 46%, Thailand 36%, and also Indonesia 32%, and Malaysia 24%. So very high interest rate. Of course, tariff rate. Of course, right now it is at 10% baseline tariff, right? 10% baseline tariff. And what is next? I think we're all anticipating what is going to happen next, right? And how important is this U.S. Market? Since we are talking about U.S. tariff, how important is it? I think for some of these Southeast Asian countries, and for your companies in particular, you can look at how important it is, the U.S. to you, for your company, directly or indirectly. For example, your customers, end market, or or your customers' customers, right? So how important it is. As a whole, take a look at the table on the left-hand side. Basically, it tells you roughly about 20% share of the exports for some of these countries. And for your company, it might be different numbers, right? It could be well above that for some of these companies who deal directly with the US, sell directly. So we do have to watch out for what is coming to us, right? For some of these countries, like for example, Vietnam, Vietnam will be one of these, one of the ones that are heavily affected, right? So that's why I think the deal, supposedly the deal that Trump announced yesterday, President Trump announced yesterday for Vietnam, they really very encouraging for the stock markets and also for companies operating in Vietnam. But there are a lot of outstanding issues that are not not finalized yet, right? Supposedly, it will be very soon before the 9th of July deadline. For example, Thailand, 21% of its exports go to US, and Philippines, 19%. And plus, I think, for example, I think Malaysia is about 16%. So it's not a small number. It's not a small number. Singapore itself is close to also 20% share. And of course, if you measure it against the GDP, same thing. The numbers vary, but some of these countries at the top will be, or region at the top will be heavily affected or significantly affected if the tariff rates come in much higher than what we have been anticipating, right? For example, Vietnam, 25% of the country output is related to the US. So that's a very significant number. Even Malaysia is about 11%. It's not a small number. Singapore, it's about 4.4%. So all these numbers, we are not talking about small numbers. It's quite a huge number. So US is very important. Now, although there is a limited visibility, we did come up with some sort of scenario of what things could look like, right? What things could look like, and that came out with one of the latest one we came out was on the 4th of June. We talk about what's the potential tariff situation that we should anticipating. Roughly baseline 10%, which is what is happening right now, and it could extend. For example, for Singapore's case, it could extend, right? Even beyond 9 July. So everybody will get 10%, and then you get a 10 plus percent, 20% for some of these exporting economies, right? 20%. And that's exactly what happened yesterday when US or President Trump announced for these tariff rate. But then the other thing, and also maybe 60% for China, I think continue to stay, maybe some variation, but we do have to watch out for sector tariffs. This one not announced yet, I think it's still in the works, but we do have to watch out for those sector tariff. 25%, there's the number that's been thrown around, including some of the sectors, for example, auto, iron, steel have already been announced. And what is upcoming, we should watch out for. And for those companies, for your companies, you're operating anything near the supply chain of semiconductor, even electrical appliances, and also for pharmaceutical, particularly for Singapore's case. If your companies operate around that supply chain of pharmaceuticals, you need to watch out for those because it might be coming. So something to watch out on the business or operation side of things in the second half of this year. All right, so let's move on to another topic after this tariff. The situation, I think, is getting more visibility, but we do have to still have to watch out and wait for further announcement. Meanwhile, what should we be doing, right? I mean, in this case here, in the US tariff, of course, we have to look out for the non-US markets to broaden or diversify away from there, right? So one of the solutions, which I think the UOB itself has our colleagues are able to support you in this area to diversify in our FDI advisory unit team. Will be able to support you if you're looking to diversify to different markets, different countries, different region, within the region in Southeast Asia, in ASEAN, since UOB is well entrenched in Southeast Asia if you're exploring in that direction. So important to diversify your markets, and like what Deputy PM Gan Kim Yong yesterday already said in the ASEAN conference, maybe even need to diversify in terms of the product offerings as well, right? Not just the markets, geographies, or sectors. All right, let's move on to another maybe also very pertinent question for many people. That is, where is the rate going to go? Peter will also tell you more later where the rates will go, but the overall principle is that I think for US, I think the inflation has been trending down. Look at the charts here. The inflation actually has been trending down, and this blue line is what we call the Fed Chair Powell's power core, right? The PCE. One measure of inflation in the US is called PCE, and it has been trending down despite tariff happening around this end part. And for goods prices, tariff has the inflation rate has also picked up a bit, but it is not at the worrying level yet, right? The pace is not worrying yet at this point. So I think there's some scope for the Fed to lower interest rate if this situation continues to persist, and then we have a more friendly outcome in terms of our in terms of the tariff, right? If the tariff rates do come down, I think that is going to be very friendly. So what we are calling for right now is 3 times US interest rate cuts for this year, starting from September, right? The environment, I think, is friendly enough to, I think, allow for flexibility. We still have to watch, so we are not looking for July to take action, but rather in September, because August, there's no meeting for the US Federal Reserve. So the overall trajectory for interest rates, I think for the US, will be should be trending down, right? The market is pricing in roughly about 2 interest rate cuts versus ours. You can take a look by end of the year, they are looking, the financial markets, futures market looking about 3.75% rate. The betting market, they're looking at 3.75%. So that roughly gives you about 2 to 3 times, right? So roughly about 2 times interest rate cuts. Okay, this is the US Federal Reserve, where we are looking at interest rate. Now let's look at the geopolitical development, my last segment before I pass on to Enrico. Geopolitics, and one of the manifestation of these geopolitical tensions and also developments is that, you know, companies or even countries seem to be moving away from the US dollar, right? What we call this dollarization, de-dollarization kind of trend. But how real is this? That coupled with a weak US dollar, and people started to ask, oh, you know, are people really dumping dollars, moving away from dollars? Now let's take a look at the data and what they are telling us. Dollar will continue to be a dominant reserve currency. I think that will stay some time. This picture is the world total reserves. All the countries, you put the reserve together, how much is a dollar portion? Roughly close to 60%. And the rest, euro is the biggest, 20%. not even half of it. It's about 20%, and the rest of others, a very tiny amount, right? They're growing maybe because the dollar has been dropping from 70% share all the way down to 60% or so, right? So it's still a substantial portion that we cannot run away. Now, if you look at SWIFT, right, this organization that consolidate all these payment instructions and all that, you can take a look at the SWIFT in terms of payments. Roughly about half of it is in US dollar. That means a payment, let's say, to pay interest payment and also to repay my loan, things like that, remittances. The instruction that you receive, 49% globally, 50% in US dollar, and euro is about 24%. Now, the SWIFT organization is very huge, about 11,000 worldwide, about 11,000 FIs in this SWIFT organization, and every year they process roughly about 150 trillion amount in terms of the instructions. The competitor, so to speak, for the renminbi equivalent, the China equivalent, is a CIPS. And again, you can take a look at the disparity between the two organizations in terms of these money flows, right? What kind of currency is in. Now, this is in terms of payments. How about SWIFT has another number, which is global trade finance, meaning your LCs and all your bill of ladings and things like that. Here, the numbers are even starker, about 80% denominated or settled or denominated in US dollar, 80%. Now, the other one is euro. It's quite big, quite consistent, 6% share. Hasn't changed that much. But the other one that is coming out very fast is CNY, Chinese currency, 6% share. It's picked up from before COVID, about 2%, now more than triple, close to triple the amount of about 6%, but still very minuscule, right? And it's going to take a long time for this position to shift, right? It is going to be at the margin. It's not a wholesale kind of situation, all right? So the bottom line is that dollar will still be with us for a while, and still we need to take care, still need to manage the risk come with the dollar, the volatility, whether you are holding dollars or you're owing dollars, right? So later, Peter will walk you through how should we be looking at the dollar and what kind of solutions our global market teams and also our RMs will be able to provide you, in the second half of this year in terms of dollar weakness. How long is it going to persist? Is it going to be all the way down or what? Right? So the dollar will still be with us. I think the important message is, and we still have to manage the volatility that comes with it. All right, so my time is up. I will pass the time to Enrico, my colleague, Enrico, who will take you through on China and ASEAN outlook. All right, Enrico?
Yeah, thanks, Tekin. So, ladies and gentlemen, good morning. The likely outcome for this tariff is that exports from China and ASEAN to the US is likely to face higher costs. And secondly, of course, they will face greater scrutiny. We've seen that in the area of, probably steel, the automotive industry, especially those related with the chips component, and probably going to continue to pharmaceuticals. So Tekin is right. I think I echo the point that diversification is key, because I think the new normal for ASEAN would be something like a multi-polar or multiple supply chain relationship overlaid by the uncertainty of the rising geopolitical tension. So that said, growth in ASEAN likely to be pulled down by the trade-oriented economies like Singapore and Thailand. Is expected to grow pretty low. So as a whole, we are expecting sub 4% kind of growth for ASEAN. But then if you look at the inflation rate, actually the demand pull is unlikely to be there. But because of the tariff, the cost per supply will actually push the inflation slightly higher. But that doesn't mean the so-called central bank is likely to put on pause or even hiking rates. Instead, what we foresee is that due to the growth weakness, while demand pull inflation is not there, we are forecasting for a series of rate cuts in Thailand, another 75 basis starting from October meeting. There'll be a transition of the BOT governor over there. And then for Indonesia, another 50 as we go through into first quarter of next year. For China, there will be about 10 basis reduction in the benchmark policy rate. Julia will talk about Malaysia later on. But the keen implication also has happened to the capital market. As we can see, the debt flow continue to receive healthy inflows because of the expectation of a rate cut, while the equity flows because of the uncertainty and the pull down of growth in the region as well as China has seen a net outflow. A much clearer picture here is a diversification, and of course, each country has an idiosyncratic risk and development, though the common, or rather the silver lining is that the equity flow still recorded a net outflow, but then the bond market is very, very differentiated. For example, Malaysia's year-to-date inflow is very strong, even outweighing the even outweighing the combined 2023 and 24 kind of bond inflows. I think on expectation of rate cut as well as steady economic growth performance for Thailand as well. Expectation of rate cuts have built up and has happened very strongly, and so does for Indonesia. Right, so I'll move on to China. So in short, China is the common denominator for ASEAN exporters, because our study has found that basically the interdependency of ASEAN exports is very low. Intra-ASEAN trade only stood at about 17%, far below the European Union 40-odd%. So this is an area, this is an area of opportunity to be explored further. For example, in the area of EV auto vehicles, basically Thailand and Indonesia are opportune trading partners. For electronics, Singapore, Thailand, and Malaysia are keen partners that can be considered to delve into deeper relationship. For the critical mineral and mining, Indonesia and Malaysia are key players in the region. So basically, as what we mentioned, China's problem also exacerbated by domestic-driven issues of property and slowing domestic consumption. And that is why I think if you look at our forecast, our Chinese economy is expecting 4.6% growth this year and going lower to 4.2% next year, and expecting the so-called another reduction in the key rates as well as the triple R. So basically, the two key messages is that China must diversify away from its investment-led growth into more consumption-led growth. This is basically exactly the reverse of what happened in Indonesia. I'll go there slightly later, but basically for China to grow its economy back, fiscal stimulus will also be key. Okay, I'll move on to Indonesia. In summary, growth is likely to fall below 5% this year, not because of tariff per se, but because of domestic-driven issues, such as fiscal and the lack of confidence in consumption. The impact of Trump tariff is very obvious in the movement of the foreign exchange rate, which is the rupiah, with its, with the market that is relatively shallow. This doesn't give enough opportunity for Indonesia to be nimble enough in terms of weathering this kind of shock as far as foreign exchange goes. That's why we're proposing on an expansionary fiscal policy in the areas of which the so-called multiplier are high. For example, accommodation, food and beverage, transportation and storage, business service, information and communication, financials, as well as mining and quarrying. So the fact that I want to highlight also that the slowdown of the Indonesian economy is predominantly driven. This is the largest economy in Southeast Asia, is driven by the slowdown in the consumption because the confidence is not there. If you can see at the scattered dot plot, we are converging towards the center, meaning no confidence, retail sales will be very weak. And basically this is this is a telltale sign that basically people are holding back consumption. What actually happened from 6% growth to 5%? The answer is straightforward. During the first commodity boom from 2005 to 11, there is spillover from the commodity to the secondary sector of manufacturing, and that prop up the demand for services, tertiary sector. This time around, despite a much bigger boom, the spillover didn't happen. In fact, if you look at the news floating around, many of the layoffs, etc., give people, the lack of confidence to consume going forward. And finally, when we can see about the risk of investing in Indonesia, of course, the movement of the currency is very, very important. Yeah. One way to describe this is using the concept of basic balance, of which two things that we need to monitor always is the current account. Two things that we need to monitor is that the movement of the current account position as well as net FDI will anchor stability of the rupiah or disanchor it. So during the period whereby current account is surplus coupled with positive net FDI, rupiah is usually more stable compared to the period where Indonesia ran a more persistent current account deficit since the end of the last commodity boom since 2011 to early 2020. After that, post-COVID, actually, we register a good current account position. But going forward, I think this will diminish, although not back to a worrying level of during a taper tantrum, for example, whereby the twin deficit ran almost 3%, each. Yeah, I think this is just a slide to basically give you an anchor view that from the external balance point of view, rupiah will be stable if current account deficit is not too large and managed to be covered by the net FDI. So going forward, I think we've talked a lot about the key areas for Indonesia to thrive on and reach a higher growth. One of which is energy transition, food resilience, healthcare reform, industry downstreaming, and to optimize the digital economy. Moving on to Thailand, the political uncertainty, unfortunately, we likely to weigh down our already weak, or rather, sluggish economic growth projection of just 2%. And then export front loading has actually taken place in Thailand, predominantly in the electronics industry. And as such, we expect monetary policy stimulus via more rate cuts, a total of 75 basis points to take place from October onwards. And exchange rate is likely to still remain stable because current account probably has come back to a more positive avenue, while I think the weaker dollar will benefit from that. So let me start with that, showing that merchandise exports to all key markets surge, especially to US and China from Thailand. And as you can see, these are mainly principal manufactured products. But if you can see, this does not benefit much of the domestic-oriented sources. Yeah, and basically we have run a report to show that solar panel, as as part of the larger electronics exports in Thailand, actually face the so-called evidence that there is a rerouting of exports from China into Thailand and then going into the rest of the world, especially to the US. So basically, that is why I think coming to the 9th of July, Thailand will be also discussing and negotiating hard about the level of tariff in order to avoid a much weaker slowdown in the economy. Deflationary pressures have also built, but again, this is a demand driven in which sluggish demand, also with the tourism industry now potentially slowing down over there because of the recent development, though I think one should not be a stranger of the political development that keeps on changing in Thailand, but still it will affect in the immediate term. So this is our expectation. 8 October BOT meeting will give a support to the economy via 25 basis cut, followed through by 17 December, and the final one, I think, will take place in the first quarter of next year. And finally, about the current account position, I've mentioned that cumulatively this year it has come back to a positive territory and likely to anchor more stability for the Thailand, save for the movement of the broad US dollar and uncertainty in the global market. So basically for Thailand, I will just close off by saying the opportunity is for them to basically ride on the new emerging mega trend, such as AI, EV, tourism and wellness, as well as the healthcare sector and food exports. So with that, let me hand over to Julia for Malaysian economic outlook. Thank you very much.
Thank you, Enrico, and thank you everyone for joining us today. A very good morning. So for Malaysia, I think the story is one that after several quarters of strong growth, I think we are starting to see signs the economy is moderating. Fundamentals are strong, and they are still supportive drivers of growth. But Malaysia's policymakers are sensitive to where growth is heading. And as we know, with the trade uncertainties, that would have added pressure on growth. Not significant pressure at this point, right? Because of the trade exemptions, the reciprocal tariff pause, and also some degree of resilience in our exports, right? However, I think the key risk is actually uncertainty. And the concern is that the longer this uncertainty prolongs, it starts to affect segments that are not even directly affected by the tariffs or by US policies, right? Of course, even with a preliminary trade deal, the tariffs are still fluid, so we'll have to see what comes next week, right? And of course, another risk or concern is that in second half, a lot of the domestic reforms, including the broadening of the sales and service tax and subsidy retargeting, could also introduce transitional changes and challenges for businesses and consumers. So given what we know today, I guess many have asked, will Bank Negara cut interest rates, particularly next week at the July MPC meeting? And the short answer to that, our view is that there is a possibility and we have penciled that in. So let's take a look at some data to support some of the views that I've mentioned. As we've observed, GDP growth has moderated. It's come off from a peak of 5.9% in the second quarter last year, right? Now, even before the announcements of the tariffs, economic momentum already slowed to 4.4% growth in the first quarter, right? So it was actually weaker than expected, right? And despite seasonal spending that pushed the monthly GDP growth to 6% in March, right? I think the concern is that going into the next few quarters with all the headwinds domestically and externally, right? And with the high base effect in the next 2 quarters, right? It's possible we could see a sub 4% growth. We are also seeing easing trends in business sentiment and private investments. It's not certain what the outcome will be on the 9th of July, but taking the Vietnam deal as a guide, I think there's a chance that Malaysia could see a tariff landing of between 10% to 20%. However, we are still cautious on a few areas, mainly because even with a trade agreement or so, right, there could be potentially higher tariffs on transshipments, as what's happened with Vietnam, right? How would those transshipments be tracked? There's uncertainty about the tariffs on semiconductors that hasn't been announced yet, and whether Malaysia's trade team actually negotiated that as part of the deal, right? And also the extent of US purchases, not only to reduce the trade deficit with Malaysia, but to reduce the dependence on Chinese supply chains, meaning kind of, in a way, forcing local manufacturers and Malaysian businesses to buy more from the US, right? So exports have been bumpy. I think we saw strong double-digit gains in April, but after that subsequently contracted in May. And what happened is that we are starting to see some of the front-loading activity start to ebb, right? Another sign is that we saw non-electrical electronic exports contract, and that could be a signal of slower manufacturing activity ahead, right? Now, moving on to consumption trends. Now, interestingly is that even though consumer confidence remains high, the overall private consumption growth has eased. And spending on big ticket items, as we see on the left side here, such as for vehicles and even home buying transactions, has actually come off, right? Now, due to higher cost of living, I think we anticipate that there will be adjustments in spending behavior, right? And again, this is not going to be broad-based, but we do see anecdotally that consumers are starting to trade down to more affordable choices. So those are some of the questions that linger going into the second half of the year. Now, one of the supportive factors for spending is the labor market. I think we can see that the unemployment numbers continue to stay quite resilient and low, right? But the question is that the longer uncertainty persists and with rising costs, right, at the risk of slower demand, there is a risk that hiring could slow, and some business may even move staff to shorter working hours. Right? Now, the good news is tourist arrivals have been forthcoming, as you can see, majority from Singapore. So thank you to my Singapore colleagues. And that's probably one of the reasons why Johor state GDP, I think, clocked up the highest GDP growth of 6.4% last year. So, of course, I think that's good news, and that's helped to support Malaysia's spending at the moment. Okay, so putting all together, right, I think Malaysia's economy, not too hot, not too cold, right? So why do we think this could compel Bank Negara to cut OPR as early as next week, right? So I think in May, they gave strong signals to indicate that they are ready to cut rates if necessary, right? They have acknowledged the higher risk to growth, worries about weaker sentiment affecting spending. Language was noticeably more dovish, right? Which is taken as a signal that potential rate cuts are coming, right? So the question now is timing, right? I think views are split between July or September. The cue from Bank Negara is that they would want to wait for more clarity with the data. But from our standpoint is that if you've already signaled and you know that there's going to be a slower growth trend, geopolitical risks have escalated, trade deals, as we have seen, it's still not fully certain and there's still uncertainty. So why wait? Okay. Now, between inflation and growth, we think concerns are more on growth. Since 1st of July, okay, there are additional 3,409 items that will incur sales tax and 6 additional sectors that will incur services tax. Okay, there's also a restructuring of the electricity tariff structure, right? And we can expect RON 95 subsidy rationalization in the second half of the year, where a 2-tiered pricing for petrol will be introduced. Okay, so I think manufacturers have said it's likely they will pass on these costs to the consumers. Okay. Of course, the official guidance is that there will be minimal impact, direct impact on inflation from SST. Okay, I think they gave a guidance of 0.2%. But how we see it is that a lot of these costs are embedded, right? And they may not show up in the inflation data. I do not discount the possibility of some profiteering as well. So anecdotally from the news flow is that cost of living is likely to be higher. So the concern now lies into how effectively the economy can navigate the external risks and uncertainties, as well as absorb the pressures stemming from some of the policy reforms and the rising costs. Okay. I think with regards to SST and all these policy reforms, we already knew that it was coming. We already knew that it was coming since it was announced in the budget last year. So we think that the government will continue to go ahead with it. It's just that probably after taking feedback from the ground, they may do some adjustments, give some mitigation measures, for instance, exemptions for certain sectors, right? And maybe, adjust some of the cash aid in the coming budget. Right. So I think with regards to the risk of how the tariffs, trade restrictions will impact Malaysia, I think the direct impact appears manageable. Okay, that's what's on this top side. But I think the concern increasingly is more on the risk from the indirect channels, the second and third order effects, and how if our other trade partners slow down, how would that actually affect demand for us? And geopolitics and Middle East, tensions, they could re-escalate again. So the silver lining is that we think that growth will be slower but manageable. As mentioned, fundamentals are strong. I think the underlying export resilience is there. I think so far, the good news is that we still see progress of a lot of the multi-year investment projects. The FDI numbers are still forthcoming, and so has the investment approval numbers as well. So in the first quarter, I think more than 2/3 of the investments approved are foreign investments, where 1/3 of it went to Johor. And finally, I think the other positive development, I think interestingly and surprised many, is that in April, May, we saw a spike in foreign portfolio flows of 22 billion in just those 2 months, mostly into bonds. And I think that has helped support the ringgit where it is today. I think it could be due to reallocation of funds into the region, the de-dollarization story, right? And of course, I think fundamentally things stable and strong, the perception is that Malaysia is relatively safer and stable during these uncertain times. Right. So again, as I said, in short, I think the picture is that it's a slower economy. We're coming from a fairly high growth last year. There are downside risks to growth, right, with the prolonged uncertainty. But again, I think there are supportive drivers, and I suppose, given that policymakers are sensitive to where growth trends are, I think we can't rule out the possibility that Bank Negara may decide to cut interest rates as early as next week. They have not cut interest rates at all since raising it to 3% in 2023, right? So they have a lot of room to maneuver. And I think, depending on where things go, we are sort of erring more on the conservative side of things, and that's why we pencil in 2 cuts. But again, let's wait and see when they do the first cut. Watch the language, the data, and the signaling, right, before we decide whether really a second cut is necessary. But again, as I said, as we are erring more on the conservative side, we've factored in the 2 cuts. I think safe to say at least 1 cut has already been priced in. Right, so I will stop here and pass over the mic to Peter, our senior FX strategist, who will take you through the FX and commodities market outlook. Thank you.
Thanks, Julia. So welcome everyone. Thanks for dialing in again. Before I share our latest view, maybe just let me set the stage of what has happened in the. Give me a second. Let me just. I think it's not sharing yet. Okay. So just let me do a recap of the first half of the year. So if you can remember, we started the year in January where we are a little bit apprehensive about Donald Trump and his potential tariff policy. So I think most of the analysts out there, including markets, are looking for Trump to do tariff, which he delivered in April. And more importantly, markets were surprising that tariff brings about inflation. Inflation means rate hikes. Or rather, the Fed cannot cut interest rates. And because of that, the Fed, the US dollar was strong, at the start of the year. And in a dramatic 6 months that follows up to now, we've seen a remarkable change of fortunes for the US dollar. In fact, in the first 6 months of the year, the US dollar index, or DXY, has dropped over 10%. This is the worst start of the year since 1973. So if you ask yourself, what has happened? The Fed has not cut interest rate at all in the first 6 months of the year. So what is really driving the dollar lower for now? And I think we can only share that the commonality between, or rather the special unique point in the last 6 months was that of de-dollarization, or the market talking about de-dollarization, meaning the less use of US dollar, be it in trade, investment, or transactions. But if you look at that, if you ask yourself, has that changed? I think, like what Tekin has mentioned, latest data do not show that de-dollarization has happened in a meaningful way. So what is really going on is right now is that a lot of financial markets participants are increasingly getting a bit worried about their dollar exposure. So they are not really selling their dollar asset at this point in time. That's the reason why you're seeing the S&P at multi-year high. You're seeing that the T-bond is also very stable right now at nearer to 4%. So what they are doing right now in the last 6 months is that market has shifted towards hedging for the dollar exposure. So they are not selling the assets, they are actually doing protection or hedging to hedge just in case the dollar falls. So when a lot of all these players starts to do that, that causes the dollar to really depreciate, like what we've seen. So the first point we can...
Pete, let me just interrupt there. Your screen is not moving. So
yeah.
Thank you. Sorry, everybody.
So what's really happening right now is the de-dollarization has caused the US dollar to drop. And in the background, we are also seeing that the US dollar is not commanding that higher interest rate going forward, because we are still expecting some sort of rate cuts in the next 6 months. So that causing additional pressure on the US dollar. So if you take these two factors together, that's caused the US dollar to go low or to go lower in the last 6 months. But the more important question is what's next? Yeah, what we cannot change what has happened in the last 6 months. What's next? And what we think is that this de-dollarization story is a cyclical story. It's not a structural story. So what it means is that as the uncertainty around trade decreases over time in the next 6 months, as we get more clarity about which country is going to have what kind of tariff, and as long as it doesn't move towards those very exorbitantly high tariff rate that we last seen back in April, I think the market just have to settle for, okay, this is no longer a free trade war anymore. We have to charge a minimal tariff. And once the market live with it, the uncertainty around trade decreases, that de-dollarization story will eventually abate. So what it left behind is, what we'll be leaving behind is only Fed rate cuts to drive the dollar. And as we've seen before, 2 to 3 rate cuts in the next 6 months, there's nothing big to begin with. So what we are saying, if you put these two things together, we are still expecting the dollar to decline, but definitely at a lower or a less intense pace compared to what we've seen before in the first 6 months of the year. So 96 for dollar index by the end of the year, 94.3 by the middle part of next year. So when we talk about de-dollarization, the biggest beneficiary is definitely the euro, because like what Tekin has shared with you earlier, the second biggest currency after the dollar in terms of trade, central bank reserve is the euro. So that's the reason why the euro is also going higher. And we continue to maintain that view. Over the medium term, there is a lot of Euro-centric positive factors, like more in defense spending, more infrastructure spending that will boost Euro GDP a bit higher. So these are all supporting factors that we are expecting the euro dollar and the euro seem to continue to inch up higher over time. For sterling, I think if you look at it in the last 5 or even 10 years, it has gone nowhere against the dollar, against the Sing. In fact, it has been gradually recovering from the Brexit saga back in 2016. So I think right now, there is still a lot of value, what we believe, especially against the Sing. I think sterling Sing well below 2 is, I think it's a good level. And I think going forward, with a lot more political stability over there, there is also an interest rate cuts wise, there's still very gradual interest rate cuts from the Bank of England. So all this supports a gradual uptick in the sterling pound against the dollar and against the Sing. For the Australian dollar, I think sad to say it is very correlated to the RMB or the CNY. So what this means is that if we have trade troubles, if we have trade war, all these are also factoring into the underperformance of the Australian dollar. So if you look at the year-to-date performance of G10 currency, Aussie is ranked the lowest right now. Even when the dollar is weak, the Aussie cannot go up too much because it is quite correlated to the trade war. But I mean, in the second half, maybe if the trade war improve a little bit, Australian dollar will have a little bit better recovery. But for now, we are cautiously positive on the Aussie against the US and Aussie against the Sing. Moving our attention to Asia, I think the first currency we talk about is definitely the RMB. Let's not forget, we are still in the midst of a trade war 2.0. The RMB cannot go too strong, especially stacked against the outlook where the economic outlook is uncertain on its own. We are still only looking at about 4.6% GDP growth for China, nothing to really excite everyone. So what we've seen is that the RMB has stabilized back to the fixing price because US and China are talking again. Tariff rate seems to be on the downward trajectory. And because of that, we are in the middle part of this fixing price. And as you can see over time, this fixing rate that we have from the PBOC tends to be the support for dollar CNY. So if there's no new positive factors for China to excite the market about taking risks again in China, what it means is that it's unlikely that we will go below the fixing price. Yeah. So more or less we'll be guided by the fixing price. And in the third quarter, we're expecting a little bit of uncertainty because US and China has not really reached a comprehensive deal as yet. So we are looking for dollar CNY to go up a little bit in the third quarter before coming off again. So if you're a dollar seller, potentially look for the third quarter as an opportunity window. Moving to our home currency, Singapore, what we are seeing is a very interesting development because the Sing dollar against a basket of currency, or what we call the Sing Near, is now closer to the 2%. In fact, based on our model this morning, it's about 1.9%. What this means is that going forward, the Sing Near cannot appreciate anymore. Yeah, it's only bounded by 2% on the upside. Yeah, so what this also means is that the strength of the Sing dollar that we see against a basket of currency in the last couple of years is coming to an end. It will soon be normalizing, meaning to weaken against the basket of currency. And we believe that the next MAS meeting in July, where the MAS is expected to bring down the slope of the Sing Near from about 0.5% to 0%. So what this means is that also setting the direction that the Sing Near cannot appreciate anymore. So if you look at history, this means that if you look at all the gray periods where these are easing cycles, it tends to means that the Sing dollar will start to weaken a little bit more. So why did I mention start by saying that we are in an interesting period in time for Sing dollar? Because the dollar Sing is now below 130. Yeah, so this is unusual level, and if there is no very strong fundamental arguing for it, like strong growth potential, which we hear from I mean, the official forecast is for Singapore GDP to be in a lower range. So there's nothing really to excite or to bring the Sing to the next trading zone lower. Yeah, and especially where the Sing is already at 2%. So what we are saying is that we potentially could see dollar Sing go up a little bit more before hovering around 128, 129 for the coming quarter. So the space for Sing dollar to really outperform is very little. And this is the last slide I have for you on the currency side. What I'm trying to say over here is that even as the dollar is weakening, we have certain Asian currencies that are a little bit stronger, which is currencies like the ringgit and the Thai baht. But on the opposite spectrum, we are also having currencies that are weaker. Even Vietnam Dong is one of them. And like what Tekin said, even with the trade deal that we have between US and Vietnam, there is no improvement in the Vietnam Dong at all. And Vietnam Dong at this morning is still trading very near to the record low. So I think going forward, this could be the trend where we'll see some winners, we'll see some losers or some laggards going forward. And moving to the commodity side, first up is gold. We are still positive on gold. Currently about 3.3. We are looking at about 3.6 by the end of this year. So this is a positive outlook. And if we expect a weaker dollar with a strong inverse relationship with dollar and gold, what this means is that the gold will continue to rise higher over time. And in terms of Brent, we have seen a very strong reversal in June. Firstly, Brent went up because there was a new war, and but I mean, thankfully the conflict was very short and swift, and because of that, all the market starts to take away all the geopolitical premium, and Brent is where it was at the start of June again, so closer to about 67. So going forward, what we are forecasting is that we are negative on Brent because we are thinking that there's a lot of supply that is coming in. At the same time, the OPEC is ready to always pump in supply if needed. And the next is on the demand side. If the global economy is to slow down, particularly China, then on the demand side, it could be a bit weaker. And because of that, it's more likely to adjust for lower prices. So at the end of the year, we are forecasting Brent to be closer to about $65. And this brings me to the end of the presentation. I should hand over the time back to Kun Hao. Thank you.
Okay. Thank you, Pete. Can I invite everybody back on the panel, please. So take in Enrico and Julia. Okay. So Pete, can you stop sharing your screen?
Yes.
Okay. Now, we are heading into the Q&A. There's quite a few questions. Questions are coming in fast and furious. No surprises, quite a few on the Fed. I'll put taking on the spot. First question we have is related to last night's stronger than expected US non-farm payroll numbers. So I think, we have been getting that question this morning. Are we still calling for 3 Fed cuts this year as a result of that stronger job number last night? Take in, please.
Yeah, sure. Thanks, Kun Hao. And so thanks for the question from our participants. Very relevant question. The number just came out, the non-farm payroll stronger than expected. Yes, we are still calling for 3 times of rate cut, no change after the strong number. We have written a report. It should be sent out already, and you should have a look at the report too for more details. Now, why are we still calling for that? Now, okay, the important thing to note is that we are calling it in September, not in July, right? So July, unlikely to take nothing unexpected to take place. And also this is consistent with also the Fed's view of wait and see, right? So these numbers are strong. We still have to see the impact from the tariff on inflation. There are a couple of things. So we have 2 months of at least 2 months of runway to see how things are evolving. And also, if you look at the details in the report, yes, the numbers are strong. Why is it the numbers are strong? One reason is because of all these anti-immigration measures. I think causing some of the people getting deported, and also you have to have I think the locals to fill in the positions, right? So it could be temporary or it could be permanent or whatever. So we do have to take a look at the data further, not just be swayed by just a 1 month's number. Want to look, of course, the trend is very friendly, meaning the trend is very positive, meaning that the job market is not a worry for the Fed. So the Fed's attention is on inflation. Like I pointed out just now, inflation, we still have to see some impact coming in from tariff. And the tariff situation seems to be a bit more calm now with the US Vietnam deal. Let's say if it's a template like what Julia mentioned just now, if it's template, I think the impact will come in as lesser. So we do have to take a look at, but we are not calling for July. I think the the futures market is also not calling for July any rate action, but September is the one. So we continue to see, I think, potentially 3 cuts this year still. Good, how?
Okay, thank you. Follow-up question on the Fed as well. And again, this is on everybody's mind regarding the potential change in Fed chair. Clearly, President Trump doesn't love chair power right now. So the question, let me just read it. Does changing the Fed chair really sway the rest of the FOMC voters? I believe the number of dissent votes very, very seldom passes the majority. I think let's take it, extend the question. We know Chair Powell retire next May, right? Whether do you think this will be a smooth transition? What happens when a new Fed chair comes on board? Do you think President Trump will have his way to, so-called guide monetary policy? Do you think rate cuts will come in more fast and furious? Yeah. Thank you, Tekin.
Right. Thanks. Thanks again for this question coming from the participants. All right. I think for the Fed chair term is expiring next year in May, like what Kun Hao mentioned. Okay, for the new Fed chair, this going to be a president's appointment, and it's also pass through Congress and whatnot. I think he's going to be his man, right? He's going to be Trump's man. So if you look at men mostly men surrounding Trump, a lot of them are very, very
maybe
loyal.
there'll be a lady. We are not sure yet. We never know.
But most of it you see on TV, most of them are men surrounding Trump, right? So very loyal to Trump. Okay, Vance casting the tie-breaking vote in Senate. Of course, he has to do it, but I think his men are very loyal to him. Now, for the Fed chair, I think most likely will be the same case. Now, even if you look at Trump 1.0, the Supreme Court appointees, right, appointments from Trump, these are basically just loyalists. So I think for Trump 2.0 is even more powerful than before. It has more sway, and look at the passage of the One Big Beautiful Act yesterday, right, in the House. Basically, everybody just basically did what they were told to do, right? So I think for the upcoming Fed chair are likely to be very friendly and will bring down. And the reality is this. The US, if you look at the One Big Beautiful Act yesterday, the debt ceiling or the amount of debt that it would be accumulated is going to be tremendous, right? 3 over trillion, if I remember correctly, 3.3 or something like that. Now, in servicing of these debt, if the interest rate continues to stay high, it's going to be very painful for the US government. So I think Trump, no matter what, I think he has to get his way by first doing something to the Fed to have the interest rate to be lower. About the other voters in the Fed, I think most of them, if you look at the way Fed operates, it's quite consensus, right? You get one dissension here and there, unlike some other central banks, the dissension can be quite high. But the Fed, I think quite a bit of them are it's quite consensus in terms of their rate decision. Now, take a look at what these voters or non-voters even have been talking about in recent months. Some of them are actually more moving towards look past the inflation impact, tariff impact. We have to do what we need to do. The conditions are tight right now. Need to do rate cuts. So some of them are already moving towards on the more dovish side of the scale, right? So I think when you have a chair that is dovish, I think most likely the rest will probably follow along as well. Hope that answered the question, Khun Hao.
Okay, thanks, Tekin. So whoever comes on board, will likely be loyal to Mr. President Trump. I think that's the reality. Pete, a few questions on currencies and interest rate. First question, again, I think we get this a lot. Overnight SORA is now sub 1.5%, right? The question is SORA has reached a year-to-date low at the start of July, even before the Fed cuts are actualized. What do you think is the floor of SORA now, given our view of 3 Fed cuts? Pete?
Yeah, so I think firstly, Singapore, we have to understand what's the reason behind why the SORA is so low. I mean, it may benefit a lot of our clients here, but I think the reason is because there's a lot of safe haven flows into Singapore. So liquidity is very flush, so price of money, which interest rate tends to be depressed. Yeah, but more importantly, going forward, what we think is that since the currency cannot appreciate, the Sing dollar cannot appreciate that much going forward. So what this means is that once the Sing dollar starts to depreciate, the liquidity will go reverse way. Yeah, and typically that will have supportive impact on the SORA. So what we are thinking is that the SORA maybe in the coming quarter will bounce up a little bit, but let's not forget the effect of Fed rate cuts, which tends to depress back the SORA. But given how far the SORA has diverged away from the SOFR, which is the US benchmark, what this means is that the spread is so wide. So even if the Sing SORA, which is below, is going lower again because of Fed rate cuts, it's not going a lot lower. So I think we saw a very low point in overnight SORA back in June. What we are thinking is that possibly we should not go that low again. But overall, for the next, at least bear with the market for a while longer. Maybe for the next 3 months, as we look at, or the next 6 months, as we look at Fed rate cuts to be transmitted once again, the SORA could remain at this depressed level for a while longer.
Okay. On US dollar, right? I think by now all of us are very clear about the de-dollarization, short dollar narrative, and even our monthly report. The title is "The US Dollar Has No Friends," right? Let me put you on the spot on this. What are going to be the unexpected developments that will cause the dollar to strengthen in the second half of the year instead? What should investors be looking out for? Pete?
Yeah. So essentially, I think we are back to the drawing board again. Yeah. So as usual, what strengthens the dollar? You look at the classical dollar small theory. You need the US data to be strong again. Yeah. So typically, I mean, non-farm payrolls yesterday night was a good example. I mean, the dollar index was off the lows because of that. Right now, it's, I mean, not really like up 1%, but at least against a backdrop where we are down 10%, anything is a good improvement. So data, we watch out for it. And the other thing that we look for is, of course, the impact of tariff on inflation, because that will prompt, that is the one that causes the Fed to move whether to cut rates or to hold rates, yeah, at this point in time. So if we see tariff effect finally having a lasting impression or impact on inflation, then if the Fed do not deliver those 2 or even 3 rate cuts, then obviously the dollar has to be going up from here. So these are the 2 obvious ones. And of course, I think if there is any geopolitical developments that could spur some safe haven currency or safe haven demand, then that could be something to watch out for.
Yeah. Okay. Of course, these are not our base case, right?
Correct.
Okay. Okay. There's a question that asks, would you advise to sell more dollar now, given that the dollar will continue to drop? I think I would just say this, right? The trend is your friend, but for advisory or what to do in terms of selling a dollar, to look for your relationship manager and as GM salesperson. They will be much more better positioned to advise you on when and how much to sell. Thank you, Pete. Moving on to Julia. Julia, a few questions on Bank Negara. There's a question basically that asks, assuming there's a rate cut at the next MPC, as you say, what do you think will be the language in the MPS after that, right? Would it, when the cut happens, would it be neutral or would it be dovish, and why? Julia.
Thanks, Edward, for the question. Yeah, I think it's that's dominated a lot of conversations, because it feels like the markets are already expecting the cut and they are all speculating what's the next move for Bank Negara then, right? Markets are always very forward looking. I would say that how we see it, we think that it would more likely be a pause, right? They may not entirely they won't probably keep the door closed completely, because as I mentioned, uncertainty is a very big factor. So you don't want to close it and then suddenly if things don't go well and then you have to reopen. So it would certainly not be a completely neutral statement, I think, even if they cut, right? But in terms of the moves, I mean, assuming where the data points are still going, it makes more sense to pause, to assess, and then reevaluate whether a second cut would be needed. Okay. I think that there was also a question on why we see where 10-year MGS is. I think question was from Hasaliza. Thank you for the question. And you're right. When you look at the levels compared to where it is, it looks, yeah, I mean, yeah, it looks dovish. But I suppose the reason for that is because we have penciled in 2 OPR cuts. I admit it is on the aggressive side, but when we forecast that cut, the 2 cuts, I think we were coming from a very conservative point of view, where we felt that even if there is optimism about the trade deal, again, as I highlighted earlier, there's still a lot of risks and uncertainties. Firstly, I mean, Trump himself and Bassett said that these tariffs are not stagnant. If, let's say, they see that our trade deficit review widens back, we can always push the tariff up. So it's not stagnant. It's still very fluid. The other question on transshipments, I think it's a big question, how you monitor that, right? And I'm sure they have an eye on where the goods are flowing from China to US. So I think that's also another risk factor. And the other one is, as I said, who we buy from. Because if you look at Malaysia's product mix of exports and imports, we actually buy a lot from China. So what happens if let's say US during the trade negotiations actually imposes certain rules or whatever, to not just to buy more from them. Firstly, it's not just it's cost as well for your manufacturers. Are you able to buy that much from the US, right? So I guess from that lens, we felt that it's not so straightforward. Now, another thing is that fiscally, yes, the government is doing the SST and all, expecting to get an additional 5 billion. We feel that they are still tight. And when we saw the initial package that the government announced, immediately after the tariffs were announced, and the government was saying, okay, we need to do something to help the businesses, right? But a lot of the package was not a direct spend of money. It was more like guarantee of loans, ensuring flow of credit, right? It's not a direct out spend. But I mean, you can't blame them because you don't really know what's the real situation on the ground. So it's better to be very targeted and sector specific. So that's another thing. So the tariffs still uncertain, even with a preliminary agreement. We really not sure. Fiscally, we think that it's tight. I mean, yes, they can achieve the 3.8% fiscal deficit. Yes, all right, but again, the leeway is quite tight, and then and hence that's why we feel that monetary wise there is room to maneuver. If you can't do anything else, but I would say the first cut preemptive. The second cut that we project is really you have to see things really go further down south, right? Then for them to decide that, okay, we may need to do the second cut. Okay, but I suppose when we made that view, we felt that things we said we were more cautious and conservative. Okay, so that was the basis of the forecast. Yeah.
Thank you, Julia. Enrico, a few questions on ASEAN and the impact of the tariffs on ASEAN. I guess that's up your street. Basically, we have concerns about the latest trade deal between US and Vietnam, right? And about transshipment. So first question is, how does that put the rest of ASEAN at a disadvantage, right?
Yeah.
Second question, I think there's a few of them trying to pick winners and, for the lack of a better word, losers across ASEAN. How do you think things will work out? Which are the countries across ASEAN that are better positioned despite all the tariffs? Which are the countries that need to respond a bit more and work a bit harder, right? Enrico.
Thanks. Yeah, okay. Thanks, Wan Hao. Sorry. I think I've alluded to before that those countries with the, more trade-oriented economies will be impacted more. But overall, I think the tariff will definitely raise costs in terms of exports. Higher scrutiny will also raise the cost. Yeah. So I think imagine if you can strike a deal within ASEAN, and the point of departure, let's say, from the lowest imposed tariff, for example, Vietnam, we know that at 20%, right? Let's say the trading partners to the US with a similar export kind of goods, let's say Singapore, Malaysia, they can work together and whatnot. I think that will still entrench the competitiveness in ASEAN. But if not, I think definitely as a whole, it will be dented competitiveness. That's the first one. Secondly, on the currency movement, those that are more nimble and adjustable, I think will weather the storm better, the shocks better. So in a way, this will absorb and mitigate some of it. So when you calculate the RER, NER, that will play a big part. But definitely competitiveness will be hit, I think, sooner rather than later. Okay. Now, it's hard to pick winner or loser. I will start, by saying that basically those with the larger domestic base, safe to say that they can weather the storm better. Indonesia and Philippines, maybe if they, they beef up more domestic trade within their country, I think they can cushion the shocks. While those that are more trade reliant, I think will be pushed to, to so-called innovate better or rather synergize better as well. Yeah. So I think in short, ASEAN as a whole, I think resiliency is, is definitely there. We have built up a lot of foreign reserves, and then our so-called import cover is well above the 3 months international standard, and then our resilience based on the flexible exchange rate movement, as well as a very unique and diverse economic drivers, I think should be combined to give us an edge to basically, weather the storm. So I will close off by reiterating that intra-ASEAN trade is too low at this stage. It was reiterated yesterday during ASEAN conference, at 17%, the room is only to go up rather than go down, especially this is a awakening call, basically from the tariff imposition. Yeah, thanks, Khun Hao.
Okay, thanks, Enrico. I think it's very important to hear Enrico repeat all the positive factors, all the underlying strength of ASEAN, and to remind everybody that, yes, we're all worried about tariff, but we have a lot of good things going on in our region that will help us weather the storm. So thank you, Enrico. We have come to the end of the webinar. Perhaps can I invite Tekin just to give a few closing remarks, a few important pointers for all our listeners out there with regards to what to expect for the second half of the year. Final comment from you, Tekin?
Yep. Okay. Thanks, Khun Hao. I think first of all, I want to thank everybody to join this webinar from all over ASEAN, actually, from all over ASEAN on a Friday morning. Really thank you, and also thank you for participation in the questions. Now, as you heard from our colleagues, Enrico, Julia, and also Peter, and also Khun Hao as well, I think the important thing is that we need to really manage our risks properly. There are a lot of risks out there, a lot of uncertainties, and that's where I think if you talk about dollar, your Asian currencies, and all those things, I think this is important thing to manage the risk of the currency that we have, and also interest rates as well. So that's the reason why I think reach out to our colleagues in the global markets and also in your RM to help you, after hearing from us what we think about the dollar, to weaken, maybe to strengthen as well, and potentially it could strengthen. And then interest rates, where it's headed, and to reach out to them, to those our colleagues in the global markets and RM, to help you structure solutions to protect your interests in this uncertain and volatile environment that we have already experienced since April, the dramatic turns and also the twists and turns that we witnessed. Right, very important to also continue, to join our webinars to learn more about it and see how they can help you to manage your business and also your risk better. Thanks, Khun Hao. Pass back to you.
Okay. Thank you, Tekin. So thank you, Tekin. A big thank you to Tekin, Enrico, Julia, and Peter. And thank you to everybody for joining us this morning. We've come to the end of the webinar. Before you go, there's a little pop-up in your screen for feedback. Do give us your candid and valued feedback, and we will try to do our best for the next webinar. Thank you very much. Happy 4th of July, and enjoy your weekend. Thank you.